Hello, I'm Kirsten Spalding, your MC for today's 2020 Investor Summit on Climate Risk digital program. I'm Senior Department Director for the Investor Network at Ceres. Ceres is a sustainability nonprofit working with influential investors and companies on sustainability challenges, including the climate crisis, deforestation, and water risk. I'd like to start today by saying that our hearts go out to all those seriously affected by the global pandemic, and we're especially grateful to those on the front lines risking so much and working hard to ensure that we all stay healthy and as safe as possible. I also want to thank each of you for participating. We realize that your personal and professional lives have been profoundly disrupted in ways really quite unfathomable just weeks ago. But your unflappable commitment and courage shown by your participation today is truly inspiring. The generous commitment and support of our speakers and sponsors who've stood by us on this digital journey to reimagine the 2020 Investor Summit on Climate Risk, co-hosted by Ceres, the UN Foundation, and the UN Office for Partnerships, is so appreciated and must also be highlighted. We clearly would not be here today without your essential support. Somehow, against the odds, we were able to transform our intended in-person convening into a digital program together. The profound commitment and conviction of so many in our community to address the dual existential threats that are plaguing our global community is inspirational. Today's topic is climate risk management in investment portfolios, an issue of concern to many of our investor network members and institutional investors globally. In collaboration with global investor networks, AIGCC, IGCC, and IIGCC, and with the generous funding from Ceres Investor Network member Impax Asset Management, Ceres has developed a series of case studies. The case studies were published today on the Ceres website, that's www.ceres.org, highlight how a number of large global asset owners assess and manage climate risks in their portfolios. They represent the evolving best practices in climate risk management. Our speakers each represent funds that were the subject of a case study. Before we begin today's session, Portfolio Climate Risk Management, Strategies and Challenges, I have a few housekeeping notes. Please note that this session is being recorded. We will be providing all participants a link to the recording shortly after its completion. If you have any questions, please enter them in the chat box that's located on your control panel on the right side of your screen. We'll do our best to answer as many questions as possible at the end of the session. And please note that there is a potential that due to global bandwidth issues, we may experience some challenges. Unfortunately, this is beyond our control. If it does happen, the discussion will pause for 30 seconds to allow for bandwidth to readjust. We want to thank you ahead of time for your patience in the event such an issue arises. Now, it's my pleasure to introduce our moderator, Simm. Ian is the founder and Chief Executive Officer of Impax Asset Management based in London. For more than 20 years, Impax has been a leader in investing in solutions to climate change and other global environmental challenges.
Thanks, Kirsten, and hello, everybody. I guess we're all getting used to this virtual world. It's a great pity not to be able to greet and meet in person in New York, but I guess there's many more people able to join this event than were able to travel to New York instead. Clearly, at this bizarre and extraordinarily difficult time, everyone's hearts go out to those who are suffering from COVID-19 and those who are helping to solve the crisis. When we look back at this time, I'm hoping that we will realize just how interconnected this world is, and we will have learned lessons about how to collaborate internationally, which of course is going to stand us in really good stead when it comes to addressing climate change, the challenge for the next several decades. As I look to Impax's work over 20 years, I would say that environmental risk and climate change risk in particular has stood out as a key question and challenge for our institutional clients. We've been looking around at investment opportunities in the environmental markets space, many of which are linked to mitigating or adapting to climate change. But I think today's seminar is very timely because it's an opportunity for those with great expertise to come together and discuss this crucial set of issues. as extreme weather events build up around the world, institutional investors are increasingly focused on the risks of managing climate change, both the physical risks as climatic belts shift and weather disruption builds, but also the transition risks responding to how society may deal with the climate change threat. And the complexities of those twin challenges are really rising rapidly up the agendas for investment officers, boards and trustees. There's been great debate in recent years about the tools and techniques for dealing with climate change risk. We've had divestment advocates, we've had a number of people advocating carbon footprinting, and more recently the use of scenario analysis to project into the future. Investor strategies have focused to some degree for some on divestment, for engagement by others who want to remain invested in certain companies. And the flip side of risk, of course, could be opportunity. And so a number of institutions have been looking proactively for investment opportunities linked to climate change adaptation and mitigation. Impax has been delighted to partner with Ceres and the Global Investor Coalition on the reports, the case studies that Kirsten mentioned at the top of the call. And the 9 institutional investors who participated so far, I'm extremely grateful for the work that they put in to make those case studies available, and they'll be available shortly after this event. There are more case studies to come, so this is work in progress. Very fortunate to be joined by 4 experienced and distinguished speakers today. As was shown in the slide at the top of the call, we have Sophia Cheng, who's the Chief Investment Officer for Cathay Financial Holdings in Taiwan, and also the chair of the Asian Institutional Investors Group on Climate Change. We have Deborah Ng, who's Director of Risk and Strategy and Head of Responsible Investment at Ontario Teachers Pension Plan in Canada. Faith Ward, who's the Chief Responsible Investment Officer from Brunel Pension Partnership in the United Kingdom. And finally, Dave Selner, who's the Chief Investment Officer from Westpac Investments and Benefits in the United States. So starting, Sophia, with you, if that's okay, would you mind just describing your institution briefly and also your approach to managing climate change? And then once Sophia's given her introduction, I'll ask the same question to the other panelists.
Okay, thank you. I'm Sophia Cheng. I'm the Chief Investment Officer for Cathay Financial Holdings in Taiwan. The financial holding company is the largest financial group in Taiwan with total assets about $320 billion US, of which Cathay Life is about 70%, and Cathay United Bank makes up close to 30%. We also run the biggest asset manager in Taiwan, second largest P&C insurance, and we have a small broker and a small venture capital. In Taiwan, half of the population is Cathay's customer. So social responsibility tends to be our natural duty we have to care about. In the past years, after we have done a lot of ESG work, we put a lot of effort into responsible investment because we believe in engagement. Over the past 2 years, we also work with the government. We want to make sure the long-term policy making is favorable for climate change. We are very active in ESG engagement, mainly on 2 parts. One is overall ESG disclosure, because ESG, without disclosure, there's no foundation for dialogue. We are also very active in climate actions because I'm very particularly worried about Taiwan. If we don't have proper solution to climate change, that can even affect the whole economy. And the other thing is, if you think about climate change, you can find better timing than today, as we are seeing more and more corporates who care about this issue, and it's time for us to help them more. The investor can no longer ignore it, otherwise, eventually this material risk can create financial damage to us as well. And our firm belief is that we think financial institutions are managing funds for general public. And therefore, it's our natural duty to think who we lend to, who we invest. And therefore, how can we leverage our power to influence our stakeholders is so important. So through the process and engagement over the past year, I'm very, very honored that we can see that we can make impact while we are still making a lot of progress. Thank you.
Thanks, Sophia. Deborah, would you like to introduce your organization and how you're managing climate change risk?
Absolutely, sure. Good morning, good afternoon, good evening, everyone. So I'm Deborah Ng. I am the head of responsible investing at Ontario Teachers Pension Plan. We manage about $207 billion Canadian in assets on behalf of 327,000 teachers in the province of Ontario. We are well diversified across the globe and across all asset classes. One thing to note is that we do manage about 80% of those assets internally, and we have significant and direct holdings in private equities, infrastructure, natural resources, and real estate. In total, our private assets add up to about $90 billion. In terms of thinking about climate change, we really need to go back to, what are our core objectives? And for us as a pension manager, it is really to ensure that we are around and that the plan is sustainable for all future generations of teachers, not just the teachers today, but the teachers that are joining the plan in years to come. And for that, it's very much aligned with how we need to think about climate change and sustainability, because it's really for the benefit of all our members. And our approach, very similar to what Sophia was saying, was really about having the best climate change risk management practices to help us make better investment decisions. We also want to make sure that we are being very effective stewards of our investments, and we engage with companies, both public and private, to adapt not just a protective approach to climate change, but a proactive approach to climate change. And we also work through policymakers and regulators to establish stable long-term policies that support a transition to a low-carbon economy. And the last note about our approach is really that, we need to invest in this. We think it's going to be very difficult to transition in an orderly fashion to a low-carbon economy without making the investments in the infrastructure and technologies that are needed to eliminate or reduce our reliance on fossil fuels. And for us, that brings us a lot of attractive investment opportunities. So I'm very happy to be here today because I think we will get to go into detail on all these pillars of our approach.
Great, thanks, Deborah. Faith, could you give us your perspectives, please?
Hi, hello everybody. So I'm Faith Ward, I'm the Chief Responsible Investment Officer for Brunel Pension Partnership. We were formed in 2017 and we're an FCA regulated asset pool for local authorities or municipals within the UK and the Environment Agency Pension Fund, in aggregate about 700 beneficiaries in total. We have about 40 billion, I think, US in terms of our assets across all asset classes, very similar to Deborah, looking at all sorts of how climate change would impact, therefore, on a whole range of different asset strategies and products across the piece there. Being both Brunel as owned wholly by those municipals, and the municipals themselves have been under increasing pressure around climate change and are very much looking for a very active approach to that. They've come under a lot of scrutiny around holdings, particularly in the fossil fuel industry. And this has created quite a strong drive to create a very comprehensive approach to how we manage these risks across all of these assets. So in January this year, we actually launched quite a comprehensive climate policy that focused in on 5 key areas of action, many of which we'll explore today, and we'll get into the detail of those. But the essence of it was that we needed to reframe more or less everything we did in terms of how we address climate change, and working in collaboration with others, we're going to have to, we hope to catalyse systemic change within the financial system. And I hope today you'll get some insights as to some of the work we've taken that might be of use to others, and also our case study goes into more detail on some of these areas. So I look forward to sharing those with you this afternoon.
Great, thanks. Could you give us your introduction, please?
Hi, I'm Dave Zellner. I'm the Chief Investment Officer for Westpath Benefits and Investments. We are the agency of the United Methodist Church that manages money on behalf of 100,000 clergy and lay, active and retired employees of the United Methodist Church. The name Westpath derives from, it honors the founder of Methodism, John Wesley, and then our desire to help our participants and institutional customers achieve a path to financial security. We're the largest world-known reporting investor on behalf of religious benefit plans. Several years ago, we recognized that we needed to articulate our investment beliefs. And we have 10 investment beliefs that outline our fiduciary obligations to our participants. One of those investment beliefs is our low carbon transition belief, which recognizes that there's a global transition to a low carbon economy that's currently underway, that's driven by the world's assessments of its environmental risks. And as a result, we think that public policies, emerging technologies, and physical impacts are creating winners and losers in the global economy. And we have a fiduciary obligation to identify what those risks and opportunities are for our fund. And so consistent with this belief, we integrated risk analysis into our funds at the highest level through what we call our carbon action plan. And this involved extensive discussions with our board of directors, and it helped define our governance and strategy for all of our investment funds. Through this process, we've identified several macro risks and opportunities for our investment funds, and I look forward to talking more about those later in the presentation.
Thanks, Dave. That's a great segue into the next question, which is actually a deeper dive into climate risk. And perhaps, Dave, you could carry on with your description about your action plan. I'm particularly interested in how you're identifying and analysing those risks. Are you using quantitative tools as well as qualitative tools? Where the metrics fit in, and what about engagement? Could you give us a bit of a description of that, please?
Sure, Ian, happy to. We recognize that it's really difficult to analyze material climate risks on our own. Hence, the key element of our program is to, especially when it comes to identifying and analyzing material climate risk, involves collaborating with like-minded investors through coalitions that have developed tools and resources that help us identify these climate risks. We're one of 24 founding signatories for the PRI. We're actively involved in other investor groups such as the Sustainable Accounting Standards Board, the Transition Pathway Initiative, and the Climate Action 100. And building on this, I'm pleased to announce publicly today for the first time that Westpac has joined the Net Zero Asset Owner Alliance, which is a group of institutional investors making the commitment to align our investment activities to achieve zero net carbon emissions by 2050. We're the second US asset owner to join this initiative, and we believe that this effort is integral to achieving sustainable global economy in alignment with the Paris Agreement, which we see as a necessary step to produce investment returns that are aligned with the expectations of our participants and our institutional investors. An example of the metrics that we use would be the Transition Pathway Initiative tool. And what that does is it assesses how companies are managing climate risk. Another example would be the Sustainable Accounting Standards Board materiality map. And that helps investors focus on climate risk related sustainability issues that are likely to affect the financial condition or operating performance of companies within an industry.
Thank you, Dave. That's really helpful. And Faith, you've been involved a lot in this area, the analysing and identification of climate risks, development of metrics and tools. So could you give us a quick overview of what Brunel's been doing?
Thank you, Ian. Yes, and indeed we use many of the same tools that Dave's outlined there, most in particular the Transition Pathway Initiative, which I co-chair on behalf, and that's very much it. And we use that because it can allows us to identify what companies have done individually in terms of the actions they've taken on climate governance, but also where their pathways are in terms of their transition and from a carbon performance perspective. That initiative, which is a free online tool, covers over 332 companies over 16 of the most carbon intense sectors globally. So we use that not only to analyse our own portfolios in terms of where the risks might be and what the pathways might be in terms of sort of from portfolio construction, but we also use it then to target engagement around both disclosure, but also in terms of setting long-term emission reduction targets with companies, and very much underpinning the work of the Climate Action 100+ that they've also alluded to. So we use that tool. We also use carbon footprinting. We find the carbon intensity targets a very useful way of identifying which portfolios are positioned in terms of as a proxy, if you like, for some of the potential risks from perhaps a price on carbon or some elements from that perspective. It allows us to prioritise when we did the analysis across all of our portfolios, Many of them were quite well positioned, like significantly below the benchmark in terms of their carbon intensity, but there were others that weren't. And then that then allows you to focus attention on those areas that need to address those risks. So we use a whole host of tools. We do also do a lot of engagement with asset managers because Brunel is 100% outsourced. So a lot of it is looking at the risk tools and techniques used by our managers. And that's where we've set a very high bar within our climate policy, saying that we are looking for managers to manage these risks effectively on our behalf. And we've put the gauntlet out there that if they're not up to the task, then we will seek alternative managers.
Great, thank you, Faye. Sophia, what keep you up to in the Cathay Financial in this area?
Okay. Cathay Financial Holdings and most of subsidiaries has assessed material climate risk to our own operating sites, the loan book, and also investment portfolio. For transition risk, Cathay Life has already calculated the carbon footprint intensity for both equity and fixed income portfolio. This allows us to understand where the greenhouse gas emission come from and then work on various scenarios on potential improvement after the risk assessment. Cathay United Bank has also applied carbon pricing scenario on major loan book so we can see how it goes. And then it is very good to benchmark global leaders. When we see how they disclose information, then they can inspire us to think about how to enhance our current methodology and brainstorm creative solutions such as green investments, for example. For physical risk, our subsidiaries has done research applying RCP simulation data based on IPCC. We are also working on some projects zooming the data into very small scale so they can apply to Taiwan's local environment. And the cases, for example, an area with more frequent floods, they can eventually affect the price of real estate. It's an important part of our business in terms of mortgage loan, commercial buildings. And another example, like extreme heat, they could affect outdoor work, and they ultimately will affect liability and engineering insurance on P&C insurance for infrastructure projects. So we also actively work with contact the government and research labs in Taiwan for additional tools, help them to develop together. In terms of engagement, Cathay, we're very honored that we are the only Taiwan financial group. We participate in Climate Action 100+. We contacted all the 3 companies in the engagement list in Taiwan. We're very happy that we can do that. We are also the only Taiwan group who participate in non-disclosure campaign for CDP since 2017. And so far each year, we are making some additional progress. And we are also contacting our investee companies, making sure they learn more about CDP, learn more about TCFD. Today, more than 90% of our external mandate managers are signatory for PRI or their local stewardship code. So we try to broaden as much as the possibility for applying the responsible investments.
Great, thank you. And Deborah, do you use any of the tools that we've heard about already? And is there anything else that you're doing that's different?
Yeah, so I won't go into detail. I think we use a lot of the same tools, be it SASB or TPI. We do a carbon footprint, which has been quite complex for our plan. We use a lot of derivatives and swaps. We have significant private asset holdings, as I said earlier. So it's been a challenge for us in developing our carbon footprint, and we've been doing it for the last couple of years, where we're actually, modeling carbon footprints on our private assets where we don't have information. So we've been focused, of course, a lot on getting that better information for our carbon footprint. I'd say the main thing that I would add to that is, knowing out there's not a lot of really good, solid, metrics to be able to assess climate risk. We have been developing our own ESG climate risk scoring methodology that really kind of looks at best practices across different companies within each sector. We use SASB as a basis. But what we're really trying to do is kind of assessing the quality and the performance on various SASB metrics to put it into context. So when a company tells us their emissions are X, we actually can have a really meaningful conversation on whether or not that is actually a very good number or a bad number. We're also working with a large asset manager in the US and a world-renowned climate research center. This is a new relationship, so I can't give any names as of yet. We've held off on our press release given the current situation that we're globally dealing with right now. And this is really a partnership for us to understand physical risks in our assets. We're working on looking at heat, precipitation, sea level rise, a whole host of different physical climate risks and how they interact with each other, and trying to get a look at what the financial impact is on our assets at a very granular level. So Sophia talked about getting information on Taiwan, you know, at a very granular level. We're trying to do that across the globe on all our assets, and really work to develop that and develop tools where, you know, any portfolio manager at Teachers can simply, you know, log on, enter their location information on their assets, and basically get a good mapping of what the physical climate risks are.
Great, thank you very much. It's a very interesting spectrum of tools, techniques, and methods. Before we go on to the next question, I just wanted to remind the audience that if you do have a question for the panel, please feel free to use the chat box. It should be on the side of your screen, and we'll do our best to get to the questions. So just moving on to the next topic, which is an even deeper dive, this time into scenario analysis. Now, in the context of COVID-19, I think we're now talking about scenarios for the removal of lockdown and what will happen to the disease over the next 12 to 18 months. But clearly, scenario analysis is also relevant for the longer term and potentially much greater problem of climate change. It is a bit controversial because it seems to be pretty difficult to get agreement on what scenarios we should use. So it'd be really helpful to get insights from the panelists as to whether you're using scenario analysis, what you've learned so far, and any tips and techniques for other investors. Perhaps, Deborah, you could start for us.
Sure. Yeah, I mean, we've been looking at quantitative scenario analysis for some time. And by quantitative analysis, we're really talking about the scenarios that sort of aim to understand or tell you what your financial impact is on your entire portfolio. Of course, I think it's pretty early days, and a lot of the models out there that we have seen aren't really able to capture the complex interactions and knock-on effects between physical and transition risks. And as a result, you know, our experience has been most of the impacts that we're seeing from these models are relatively small. And they're difficult for investors to understand in a way that can really inform investment decision making. And that's our goal, is to make sure that this is something that we can sort of incorporate in how we make decisions. You know, we have over 300 investment professionals that are making these decisions for the pension plan every day. So we've been looking for something that was transparent and credible that could be used. So we've opted to take a more qualitative approach. I know there's probably a lot of critics to a qualitative approach, but we did that, and we mapped out 3 extreme scenarios and looked at how different asset classes, sectors, and geographies could be impacted under each scenario. Dave talked about, you know, there's going to be winners and losers, sectors that are disruptive. So we're trying to sort of understand how that could all play out. But of course, you know, we don't know which of these scenarios are likely to happen. Likely none of them are actually going to turn out the way we looked at it. So, you know, the important part of our work is really, you know, understanding the catalysts that drive those scenarios. And these are things like policy, of course, technology, consumer preferences, so how are people making decisions on buying, capital flows, and of course physical impacts. And unfortunately, there isn't really a convenient metric that you could assign to each one of those catalysts. So instead, our approach was to you know, look at what was measurable out there, and we defined kind of 12 measurable proxies that help us understand how these catalysts are changing. So some of these signposts are things like fossil fuel subsidies, battery costs, carbon pricing, meat consumption, and deforestation. So we kind of mapped out what the values for each of these signposts are under our 3 different pathways. And we call them pathways because we're not just trying to understand, say, looking at what does this look like at the end of a 30, 40, 50-year horizon, but over the next 0 to 30 years. So this allows us to monitor every year how each signpost is changing year by year, and then how the signposts are sort of interacting or coming together in aggregate. And we feel that this is actually giving us much better information to the teams on which way the world is trending, helps us make better long-term decisions. So for example, we can use those signposts and what values they are to stress test our investment decisions against a wide range of extreme assumptions to see if we're still comfortable holding that asset. And giving that insight and common language for talking about climate change and a common understanding across the organization of how things might pan out has been really powerful in kind of mobilizing all 300 investment professionals to be thinking about climate change every day.
Great, thanks, Deborah. That's really interesting. Sophia, could you pick up what have you been doing in scenario analysis at CAFE?
Okay, CAFE has formed a TCFD team in 2018, and the team is led by our group chief risk officer and is directly supervised by the CEO. We have break down the team into 4 groups: the green products, real estate and mortgages, commercial loan, and security investments. Each subsidiary, they will also have a dedicated member to join each group. Every subsidiary, they will learn from others existing tools and methodology and thinking about, can I convert that to my analysis? They can also leverage the other group subsidiaries together to evaluate some additional external database. So we are in the process of evaluating more possible tools we can have. And for example, one of the biggest direct impact from physical risk we have is real estate. As CAFE owns more than 200 buildings in Taiwan, we also lend to mortgage secure loans collateralized based on property. So we can analyze very long-term simulation for potential losses under various RCB scenarios and how big the damage could be in a single climate event. Currently, there are still some constraints on data which need to be more sophisticated, but it will only get better when you start to do it and thinking about how to improve it. Taiwan is very unique. We have more than 100 years of climate data, which I believe can be developed into very useful tool in the future for local markets. And other working groups such as securities investment also have a lot of work on similar areas. And one point I like to highlight is very often when I go to seminar, I hear a lot of complaint about lack of data availability, especially on the database for physical risk. I just like to share my thoughts that I would suggest, please do not fall into love and hate with data. There will be always constraints. For example, if I know somewhere it's going to be flooded 20 years from now, do I want to lend 20 years mortgage or 30 years mortgage? You don't need a precise data to make a decision. So it's not the data perfection that matters. It's what we plan to do after any level of analysis we have done. You don't need perfect data analysis to start some obvious actions. And only when we start to have some initial finding, we start to brainstorm that, then we can understand, oh, this is extra tool we may need. So the whole process, communicating with other colleagues in the group, is a lot of fun.
Great, thanks for some very helpful points there. Faye, what about Brunel and scenario analysis?
Thank you. And yeah, I'm going to take a lead a little bit from the answers from Deborah and Sophia and sort of work up some of the work we've been doing. But we're very much probably at the beginning of our journey on this. But similar to Sophia, we're gathering our data on our property, for example, and then but we're still data gathering. So we're asking them for kind of location data. We have hundreds and hundreds and hundreds of buildings as we within our real estate portfolios as we onboard those. So that's quite a massive data gathering exercise. We're also asking them for their energy efficiency as well for mitigation scenarios as well. So very much building that data bank in order to be able to do scenarios in the future on like water stress, on heat stress and coastal rise is probably the 3 areas we'll look at once we've got that data all in place. Then at a more listed equity level, we're using the Prudential Regulator Authority issued some guidance to the insurance sector within the UK, but it's actually got uses much more broadly than that. And we're using some of their sectoral analysis of some of the impacts that they have over 3 different scenarios. And we've hardwired that one into our risk analytics that we look at, so we can look at all of our listed equity portfolios as to how they might perform against those. A little bit challenged at the moment is to give me answers, but I still don't know quite what to do with them. But it's part of that process. We're very much at the beginning. So at the moment we have numbers, but as Deborah, we haven't got quite as far as Deborah in working out what looks good and what doesn't. But we're generating the numbers, so it's a first step. And then strategically, we've got 2 things that we're using. One is we're looking at the UNPRI's work on the inevitable policy response to look at some of those macroeconomic shifts that may occur. That isn't so much a scenario, but a forecast. But it gives us some ideas as to so if this happened, this qualitative analysis like Deborah was talking about earlier, if the sales of internal combustion engines, if the withdrawal of permission to sell those happens in different countries, what would be our impact on our portfolio? So some of that qualitative analysis. And the other piece of work at that strategic level that we're doing with the Institutional Investor Group on climate change with a collaboration is identifying what does a 2-degree portfolio even look like. And again, that's very much at the early stages of looking at how would we need to amend or adjust our portfolios and what would be the financial consequences of that, perhaps using more traditional financial measures. So looking at those through a series of scenarios, particularly focused on the well below 2-degree and 2-degree scenarios. So looking at those what adjustments would we actually have to make? But as I say, we're still at the process of doing all that work. We don't have any answers, but we are starting to pull together the numbers.
Great, thank you, Frank. That's very interesting. And Dave, what about Westpath? Are you using scenarios yet?
Yeah, well, Ian, we've had to rely on our thought-leading external fund managers who assisted us with the scenario analysis. So, for example, we've really been impressed by PIMCO's efforts to develop tools that assess holdings in all of our portfolios under various scenarios. And a specific example of their analysis was performed looking at the energy mix of our public utilities holdings in each portfolio, such as the fuel that they use to generate electricity, and then compare it to the expectations required under the Paris Agreement. And they use the International Energy Agency's 3 scenarios. When they did this analysis for us, it did discover and reveal that our funds had greater coal usage than required under the Sustainable Development scenario, and then it also had greater natural gas usage than under all 3 of the scenarios. So this information was really helpful to us, and it helps us focus our efforts in engaging our asset managers on how they might consider addressing material climate risk.
Great, thank you very much. So just now turning to the 4th question, once we've got all this risk information, of course, there's an opportunity to think about making portfolio adjustments. One of the ways to adjust the portfolio is to consciously look for climate solutions, so those companies that are providing products and services that can thrive in a world of climate change and climate change response. And so I wonder whether you could just give us some insights on what you're doing in the climate solution space, perhaps a few examples. And Dave, would you mind just kicking that off?
Sure, thanks, Ian. I'd be glad to. In November 2018, we launched what we're calling our Transition-Ready Portfolio Strategy, what we refer to as TRP. And that was through a collaboration with one of our external asset managers, BlackRock. Initially, we transitioned $750 million from 2 of our passive portfolios to the TRP strategy. And then after promising initial results, we transitioned another $350 million in the middle of 2019, and that was from a 3rd passive strategy. BlackRock uses their proprietary tools to evaluate a company's path on the low carbon transition, and they've identified 5 pillars that they use to generate alpha. And those 5 pillars are energy generation and production, carbon efficient technologies, energy management, waste management, and water management. A key element of that strategy is the use of their carbon beta tool, which is an analytical tool designed to diagnose a portfolio's current profit and loss potential associated with their exposure to carbon prices. The analysis is a snapshot in time and assesses a company's potential liability to carbon prices. It applies a $40 per metric ton of GHG emissions tax. And then a company's total GHG emissions are based on a number of assumptions, including its scope 1 and scope 2 emissions. It's priced through an absorption rate and its exposure to clean technology. You know, we've been really happy with the investment performance. It's actually exceeded our expectations. Notably, our international strategy has outperformed a cumulative 400 basis points relative to the passive benchmark over the last 17 months since it was launched.
Excellent, that's very helpful. Thank you. Sophia, what about you? What is CAFE doing in the climate solution space?
When we see that climate change is so important, we have spent quite many years into potential green investment and low carbon area. So our subsidiaries are quite active in renewable investment, probably one of the biggest lender to solar energy loans in Taiwan as well. So as of today, the financial holding company on aggregate basis has accumulated low carbon investments, which is more than $5 billion. Cathay United Bank is the first Taiwan bank who signed the equator principle, and we feel very happy that you have the self-discipline thinking about the impact to environment. It has done the most loan case, project finance case applying equator principles. The bank should have one of the best project finance team in Taiwan. Cathay Life has a target of at least 5% annual growth in low carbon investments. And for example, all new building Cathay Life has must be green building. Cathay Group is also one of the largest investors in solar and wind power generation projects in Taiwan. And in some cases, Cathay Life is a major, has significant stake. This equals to more than 1,200 megawatts or 1.7 million tons of CO2. Cathay Life on our own operation, we also install solar panel on the roof of our buildings. It's in early stage because in central and southern Taiwan, there's abundant sunlight you can apply. So in only early stage, we just have accumulated power is more than 5 megawatts, which is about 3,000 tons of CO2. So I hope they will grow much faster. And in terms of the return, do we have to suffer return from green investment? It depends. Actually, all the renewable energies project I have mentioned, the IRR are relative attract better than some other fixed income asset, as the government does encourage development for more renewable energy. This country has a target by 2025. The country wants to have 20% of energy come from renewable, because today Taiwan and Korea, other two countries, more than 95% of our energy depends on imports. So that's why we try to support the renewable energy. Once it goes to a capacity, then we can start to engage government to be more efficient to deal with the traditional energy source.
Okay, thank you. And Deborah, what about Ontario teachers and climate solutions? What are you doing?
Yeah, I mean, we don't have a specific allocation to climate solutions because we actually think there's actually opportunities across all our asset classes. So again, always more effective to focus the entire investment teams through consciously, as you say, evaluating climate type of investments. For us, I think we're a big plan too. So a lot of the climate opportunities have, in the past been more difficult to scale up to something that would be meaningful for us. So we've actually created a variety of different investment platforms. So for an example, we created a renewables platform a number of years ago. We started with just 19 assets in wind, solar, and hydro. And we've just let that portfolio grow, and it's now grown to about 87 assets across a wide range of countries. So that's been a way through that we've kind of incubated various sort of technologies and try to grow that allocation more slowly. But we've also focused a lot on existing assets. So like many of you here, we have a large real estate portfolio. We have almost about 30 billion, just under 30 billion in real estate, where we actually have direct and operational control. So we have been working a lot over the years in, almost all of the assets are now LEED certified or equivalent. And, we're active in setting sort of annual and long-term targets on things like efficiency, water, waste, etc. So, potential with 30 billion to have a large impact on that. I'd say, we're also a large investor in private companies, and there's a lot of different opportunities or projects within these companies that you can talk to managers or your external managers about in terms of, energy, resource, and emission efficiencies, right? So working with portfolio companies to build a plastics recycling plant or water recycling. There's a lot of smaller sort of projects that maybe fall under the radar or aren't quite pure play. Which is another reason why we haven't really set out to sort of measure, how much we have in climate investments, because it's all over the place. So I think, yeah, there's lots of opportunities everywhere, and our goal is really to, as Faith was talking about, in terms of how do you measure that, or how do you start capturing some of the transition readiness in companies as well.
Excellent, thank you. And Faith, what about Brunel and climate solutions?
Well, very similar to Deborah in the sense that we haven't got a specific allocation, but seek opportunities across any of the asset classes. So, for example, the first phase of our infrastructure fund had 35% dedicated to actually greenfield renewable as a proportion of that. We're seeing strong client demand, strong pipeline. We just think these are quite good, good investments across a multiple of asset classes. So we consider seeing a lot more of these in our portfolios going forward. In terms of a bit like Deborah as well, in terms of actually grabbing hold of just what we've got where and what box you would kind of put it in. I think we're looking for things like the EU taxonomy, where they've defined it. We know it's not perfect, but we think that that's a really good framework to start to kind of capture and perhaps pull together on a consistent framework. So that's work that we'll be working on later this year.
Excellent, thank you. That's really helpful, comprehensive answers from everybody. I'm just conscious that it's pretty much 10 to the hour, so we've probably got time for one more round. Noticed some great questions coming in from the audience, so what I thought I might do is roll a couple of them together. So please pay attention, because there's going to be a couple of questions coming at you at the same time. So if you could just frame your answers in 2.5 minutes, I think that should just see us out in terms of the remaining time. So the two questions are quite different. First of all, what sort of institutional challenges have you faced in implementing climate policy? What sort of obstacles have there been? And secondly, what's on your to-do list for the next 12 months in climate change? What are your priorities for the coming year? So, Faith, if I could start with you, is that right? Sort of obstacles and challenges, and then priorities for the next 12 months.
Was that to me, Ian? Sorry, right? Thank you. Yeah, no, that's fine. I was just checking I heard correctly. So no, thank you for that. So institutional challenges, I think, and that was one of the key things we actually identified in our policy, actually, was the fact that because climate risk is not properly priced in, there's some quite deep-seated challenges in terms of the distortions created by fossil fuels. I think Deborah mentioned those earlier. And therefore, connected to that, how we're actually measuring things. So if you're the way that we traditionally measure our success in terms of usually relative to a benchmark, well, those benchmarks, traditional listed equity benchmarks, are taking us to 4 degrees of warming, which isn't the objective we're working to. We're working to a well below 2 degrees. So we recognise that some of the ways we measure success are flawed. So some of our priorities are going to be around kind of how do we need to measure progress and going forward, because, as I say, traditional benchmarks don't look to be the rational basis for doing that. Product availability, we found there's limits, particularly when you start getting outside of traditional asset classes. So in sort of multi-asset credit, climate awareness, climate resilience is quite, there isn't very much there. So because our clients are looking for those type of funds across their asset allocations, not just in niche parts of the sort of listed equity or private markets, but they're wanting to have their whole pension fund to be climate aware and climate resilient. So some sort of institutional challenges there to overcome, and a lot of those are our priorities, really. I suppose the first stage of that is, we've touched on this a lot, is how do we actually even identify where we're at in terms of where the portfolio is at, in terms of what pathway we're on, and also identifying and reporting. I think one of the key things we're looking at is our own disclosure and actually getting some of the facts and figures, so we've got a good baseline as to where we're at, and then therefore where do we want to get to in terms of those, and then what are the right tools and measurements that we need to use. So for example, reframing benchmarks, that sort of thing. So yeah, it's quite fundamentally quite a lot of how our traditional financial systems work that we think need reframing, and that's one of our priority areas for 2020.
Excellent, thanks very much. Deborah, what about Ontario? Can you tell us about the obstacles and challenges on the one hand, and also your plans for the next 12 months?
For sure. I'd say that the challenges in the past have really been, how do you get 300 investment people to think the same way and share your views on climate change and act accordingly? So, we've addressed that through a lot of, tone from the top, right? The CEO and CIO, and getting all the senior management on side with what we view, how we view climate change as a risk. And I think the other challenge is, a lot of times some of the tools that we use for climate change they're not huge risks today, right? So if you think about a company's emissions profile, and yet the company is needing a refinancing because demand has dropped tremendously. So there's always been other kind of more pressing issues that come up within a company. So it's making it a challenge to kind of focus people's attention on climate change. Case in point, what we see going on today, all our entire staff and portfolio managers are busy talking to their managers, talking to their companies to understand how everyone's dealing with COVID-19 right now. So I'd say our priorities for this year is really, kind of nailing down that metrics and targets part. We kind of understand and know the limitations and even ineffectiveness of using portfolio carbon footprint to manage climate risk. I think it's a part of it, but we really want to understand, what's the most effective measure that we can actually manage to. And I think it'll be a suite of metrics, not just one or two things that we look at. Transition risk has been a big challenge for us. I think, Faith, I want to talk to you because I think we're on the same page in trying to think about how do we measure transition risk in our plan? What does that a 2-degree portfolio look like? What do we look like relative to that? And I don't think we have the right metrics. I don't think carbon footprint's going to be that golden rule to tell us, okay, are we aligned with 2 degrees or not? I think it's going to be a mix of what are the companies doing, what are the sectors and geographies that you're investing in, to really understand, what does it mean to be resilient, right? So I think we're taking that step back to analyze what's out there, what's the right measures that we will use, and then really, figure out a path forward in terms of, where do we want to be and how do we get there.
Excellent, thank you very much. Dave, what's happening at Westpac in those two areas, obstacles and then priorities?
Sure, in terms of challenges, I would characterize them as two. There's the communications challenges with our stakeholders, and the second challenge is ensuring that our investment managers have sufficient information to perform robust analysis of the companies in which they invest. The first one, a significant portion of the membership of the United Methodist Church is located in parts of the countries that have not fully embraced the need to transition to this low carbon economy. And so they question our motives on what's driving us in this low carbon transition. And we truly believe that it's fulfilling our fiduciary obligation to position our funds and position our portfolios in alignment with the risks and opportunities that we see resulting from this transition. So the challenge is ensuring that we have sufficient communications to our stakeholder base to convince them that what we're doing is fully aligned with our fiduciary duty. The second is in terms of getting robust information to our investment managers. And that's where I think our role as a member of the Investor Advisory Group, the Sustainable Accounting Standards Board, comes into play. That group is trying to convince companies to adopt the standards so that our investment managers have the information they need to make proper decisions. In terms of what we're going to be focusing on for the next 12 months, Again, it's to work through our existing partnerships, the TPI, our new partnership, the Net Zero Asset Owner Alliance, and to determine what's the best way that we can move forward, and then fully engaging with our external managers to conduct these scenario analysis for their individual portfolios, rather than relying on one of our thought leading managers to do that analysis for them.
Perfect, thanks Dave. And Sophia, some brief thoughts from you on obstacles and plans?
The first obstacle we had at that time was how to build internal consensus. It takes years, and it's so done. So today we don't need to explain to our employee why we are doing it. The second one is lack of proper disclosure by investee companies. And this is why, besides climate change, we focus a lot on ESG disclosure for our engagement project. Without disclosure, there's no foundation for conversation. Number three, engage as many stakeholders as possible. That includes even governments, other investors, investee companies, because they may all work hard in their area, but you know, you need collaboration among all to make this work if you think about a country's level. So we want to be the bridge to connect all these parties together. And the other thing is, many of them still think climate change is a very remote problem. They need education. So that's why I have 6 seminars in a day. And priorities. Number one, expand engagement list. Number two, help the government on policies. Number three, work on scope 3 emission improvement. And number four, complete evaluation on simulation tools that we can adopt some suitable ones. And lastly, engaging government on energy policy and the cross-area cooperation, because I do think the climate change eventually could also be national security problem, because it's not just Cathay's problem. Taiwan depends on exports, and it's so important corporate understand this global trend. It would be too late if they fail following making better action on climate change, and eventually if they don't do it, they can be eliminated from global supply chain. This then become an economy problem, become a potential loss in your loan book or your investment portfolio. So that's why I think no excuse. Climate change is our common challenge that we must face together.
Excellent, thanks Sophia. I think we're just about at the top of the hour, so really for me to wrap up very quickly by saying that COP26, which will now be in 2021, will be a very important landmark for all of us in trying to come together with policies that we can take in front of governments and companies that we'd like to see the economy follow over the next few decades. So thank you so much for listening. It's been a really fascinating hour. I'm going to hand back to Kirsten just to wrap things up.
Thank you, Ian. What a fascinating panel discussion. There is so much happening in the field of assessing and managing climate risks in institutional portfolios, in developing qualitative and quantitative tools to assist investors in doing so. This is really exciting work and a rapidly evolving space. I encourage you to read the case studies which we've developed. The 9 will be posted on our website today at www.ceres.org/case studies. As I mentioned, the case studies showcase 9 large asset owners, some of whom you've heard from today, and you can see the full list on your screen. We're so grateful to Impax Asset Management for providing the financial support for this project, which provides useful examples to other investors who are at an early stage of their climate journey. As practices around managing climate risks continue to evolve, Ceres will continue to support investors as they look to achieve Paris-aligned portfolios, and we'll be working through our new Ceres Accelerator for sustainable capital markets and the investor agenda with our global partners. I want to take time to thank our speakers, Ian, Sophia, Deborah, Faith, and Dave, and thank you to our attendees for taking part in today's session. Before we adjourn, I want to take a special note to thank the summit co-hosts, the UN Foundation, the UN Office of Partnerships and Ceres, and the sponsors who you'll see on the screen, who provided instrumental support for the 2020 Investor Summit on Climate Risk digital program. Please note that you'll receive a follow-up email shortly with a recording of this session. And for those of you who are part of the Ceres 2020, another session will be taking place on Wednesday, that's tomorrow, on the topic of greening the supply chains in China with Linda Greer, Senior Global Fellow, China Affairs, Institute of Public and Environmental Affairs, and Ma Jun, Director of the Institute of Public and Environmental Affairs. To register or learn more about upcoming sessions, go to series2020.org. Thank you all so much, and this session is adjourned.